Okay, let's do an example of solving a pro forma financial statement. So refer to your financial statement handout for Super Corporation 1. We're going to construct a pro forma income statement for 2021. Here are going to be our assumptions. We're going to assume that sales will grow only by 10%, assume that there will be a 60 million purchase of property, so 60 million for CapEx, a $200 million dividend, and we're going to base our percentages on data from 2020. So we're going to need to look at our balance sheet data from 2019 for depreciation and interest expense. So let's do it together. Okay. So the first thing I want to do is I want to write pro forma 2021. I want to write my ratios. Okay. So my assumption is going to be that sales are going to grow by 10%. So let's take this and multiply it by 1.1. And now let's get our ratios. Our cost of goods sold. So our cost of goods sold is going to be a fixed function of sales, cost of goods sold is going to be a fixed function of our sales from last year. Our general expenses are going to be a fixed function of our sales from the year. Our R&D is going to be a fixed function of sales. And now we've got our depreciation. So for our depreciation, we want to make this a fixed function of our property, plant, and equipment from the previous year. So this is going to equal depreciation in 2020 divided by, we go to our balance sheet, our property, plant, and equipment from 2019. Okay. We also have our interest expense, and it's the same idea. Our interest expense, we want this to be a fixed function of the amount of debt that we borrowed in 2019. So we take our 2020 interest expense, and we're going to divide that by our balance sheet, our long-term debt from the previous year. Lastly, we have our taxes. So how are we going to do our taxes? Well, we know the tax that we paid, and we also know our net income. So we're going to assume it's going to be held fixed. So now we have everything that we need in order to complete our net income pro forma. So let's do it. What do I expect? I expect that my sales are going to increase by 10%. So my cost of goods sold, I'm now going to take that ratio and multiply it by my projected sales for 2021. My general expenses, I'm going to take my ratio and multiply it by my sales for 2021. My R&D, same thing. I'm going to take my ratio, multiply it by my projected sales for 2021. For depreciation, here I'm going to use this ratio, but instead of sales, remember it's going to be a function of my PPE. So I'm going to multiply that by my property, plant, and equipment for 2020. For my interest expense, I'm going to take my ratio. I'm going to multiply that by my current long-term debt. So my long-term debt for 2020. Here we go. So now let's total these through and see what we're finding. So first, my gross profit is going to equal my sales minus my cost of goods sold. So I've got a gross profit of 792 million. I now need to reduce it by these expenses. So my earnings before interest and taxes is going to equal my gross profit less my general expenses, less my R&D, and less my depreciation. My pre-tax income is going to equal my earnings before interest and taxes. So this minus my interest expense. And now I need to figure out how much I'm going to pay in taxes. Well, I'm going to assume that my tax rate will be the same. And I'm going to multiply that by my pre-tax income. To get my pro forma net income, I'm going to take my pro forma pre-tax less my taxes. And so for our pro forma, given our assumption of sales growing by 10%, our $60 million in CapEx, and our $200 million dividend, we're going to project that we'll have net income in 2021 of $175.68. Okay. We can also construct a pro forma balance sheet. So for our pro forma balance sheet, there are a few things that we want to just kind of clarify and make sure we're on the same page with. First is going to be our cash and accounts receivable. We're going to assume that our cash and accounts receivable are a function of our sales. And that makes sense because, again, accounts receivable, it's the money that we've got coming in from the stuff that we sold. And cash, obviously, we sold stuff, we got cash. Our inventory and our accounts payable, we're going to assume are going to be fixed percentages of the cost of goods sold. That also makes sense because our inventory is the stuff we produced but haven't sold yet. And our accounts payable, well, that's the IOU that we owe to other companies because we've been receiving things and haven't paid for them yet. For some minor items on the balance sheet, we're going to assume that they remain unchanged. So whatever they were the previous year, we're going to hold them fixed in the pro forma year. There are going to be some other important items that are in our balance sheet. The first is going to be our PPE. So our property, plant, and equipment. It's going to increase by the CapEx that we have projected, but it's going to be reduced by our depreciation. The next is going to be our shareholders' equity. So our shareholders' equity, it's going to increase by our net income, but it's going to be reduced by our dividend. Lastly, with our pro formas, we can always figure out whatever the firm's funding need is. So remember, our assets equals our liabilities plus our equity, even for our pro forma balance sheets. However, with the pro forma, we won't always produce an initial balance where assets equals liability plus equity. If we have an imbalance, meaning that we have our assets not equal to our liabilities plus our equity, then we have a funding need. If our assets are too big relative to our liability and equity, we have a funding need. If our assets are too small relative to our liability and equity, we have a funding surplus. That imbalance, the difference between our assets equaling our liability plus our equity on our pro forma statements, is going to let us know what our actual funding need is for the firm. The way that this happens is we'll see, once we actually kind of go through our projections, what is it that we're missing? Well, if we don't have enough, i.e., if our assets are more than our liability and equity, we're going to solve that by issuing some long-term debt. And if we have too much, if our assets are less than our liability and our equity, we're going to solve that by retiring some long-term debt. So we're going to figure out how to meet our funding need or surplus, this imbalance between our assets minus our liability and equity with our long-term debt. Lastly, from our pro forma balance sheets, we can also figure out what our net funding need is. So that net funding need is going to be the negative of our operating cash flow minus our change in net working capital, minus our investment in fixed assets, minus our interest, and minus our dividends. This equation calculates the additional cash, which could be negative, that we would need to fund our future activities. Again, if there is a positive need, we can remedy it by issuing an amount of long-term debt that is needed. So our pro forma balance sheet, we've got our funding need, our net funding need, and if you can recall from your intro finance course, your operating cash flows are your net income plus your interest plus depreciation, and your net working capital, it's your current assets minus your current liabilities. So let's solve an example together. Refer again to your financial statement handout for Super One Corporation. We're going to construct a pro forma balance sheet for 2021. We're still going to assume that sales are going to grow by 10% next year. We're going to keep all of our same assumptions. There's going to be a capital expenditure of $60 million, there's also going to be a special dividend of 200 million. We're going to correct any imbalances adjusting long-term debt. Hopefully we can see what our funding need will be for 2021. So let's do it. If we go to our balance sheet, okay, we're going to do the same setup. First, I'm going to write pro forma 2021. And here I'm going to write ratio / formula, just because there's a lot of stuff that I want to remember that I need to account for. Okay, so cash, this is a function of our cash currently divided by our sales.